Welcome to Iron Financial. This is the channel where we forge stronger portfolios, and we do it by putting companies to the test. Look, we don't deal in hype around here. We deal in numbers. We stress test the balance sheets, the income statements of some of the market's biggest names to see if they're actually built on solid rock or just shifting sand. And today we are diving deep, really deep, into Pool Corporation, ticker POOL. Now, this company, you know them, they rode that pandemic wave to some absolutely incredible heights. But now, well, the tide is definitely going out. So the big question is this a business with a truly durable foundation, or is it about to get swept away by the current? We're about to tear apart their latest earnings report and their outlook to find out for sure.
Okay, let's get right into the weeds. The single biggest question on every investor's mind, it's pretty simple. Is the post-pandemic pool party officially over? You remember, for a while there, it really felt like every single backyard in America was turning into a private resort. You had stimulus checks, you had stay-at-home orders, and all that fueled this absolute frenzy of demand. But, the music has definitely stopped. Consumer spending is tightening up, interest rates are starting to bite, and that dream pool, well, for a lot of people, it's suddenly become a maybe next year kind of project. The market is really trying to figure out if Pool Corp can handle this hangover, or if that boom was just a one-time sugar rush that's left the company with a massive headache and, frankly, a very vulnerable stock price.
So before the bulls even think about starting their victory lap, let's talk about a number that I guarantee they would rather you just ignore. 40%. No, that's not a typo. That is the cratering, the absolute collapse of new pool construction since the peak. This isn't some gentle little correction, folks. This is a free fall. This one number, it's the hurricane that Pool Corp is sailing straight into. So any talk of a solid foundation has to start by answering one simple question. Can this ship actually survive a storm of this magnitude? Because right now, the waves are crashing over the bow.
So that is the battleground. And here's exactly how we're going to break it down. First, we are going to build the strongest possible bull case for this company, really looking for the steel beams that are supposed to be holding it up. Then, our market skeptic is going to grab a sledgehammer and do his level best to find every single crack in that foundation. After the dust settles from that, we'll look at what management themselves are saying about the future. And then finally, we'll step back, we'll weigh all the evidence, and we'll give you the official Iron Financial verdict. Let's get to it.
All right, let's do it. Let's build the bull case. If you're going to bet on this company, you have to be able to see past all the noise of the housing market and focus on the bedrock of the business. The real strength here, see, it isn't in selling shiny new pools. It's in the boring, unsexy, but unbelievably profitable business of just keeping existing pools running. This is where Pool Corp has built its fortress, and it's a fortress the market might be seriously undervaluing right now. Let's take a look inside.
This slide right here is where the bull case really starts to shine. Just forget about new construction for a second and look at the elephant in the room. 64% of their sales, 64% comes from maintenance. This is the company's secret weapon. We're talking about the chlorine, the filters, the chemicals, all the stuff you absolutely cannot avoid buying unless you want your beautiful backyard oasis to turn into a green, murky swamp. This isn't a discretionary purchase, you see. It's a non-negotiable expense. It is essentially a hidden utility business. Every single one of the millions of pools already out there is a lifetime customer. And that creates a powerful, and I mean powerful, recession-resistant revenue stream that I think the market is seriously underestimating. It's an annuity that just pays out year after year after year.
And hey, don't just take my word for it. Listen to the CEO himself, Peter Arvin. He's not out there on the earnings calls hyping up new pool sales. No way. He is relentlessly focused on the stability of the maintenance business. And you have to understand, this is a very deliberate strategy. They are telling Wall Street, yes, we know the new construction market is tough, but you are missing the real story here. They are actively directing investor attention to this predictable, recurring cash flow engine. They're managing the narrative, and they're pointing to this as the exact reason this company is a safe bet, even in a downturn. That is a really powerful message, and it's coming straight from the top.
Now this is where you separate the winners from the losers, okay? When sales go flat, most companies, what happens? Their margins get absolutely crushed. But look at Pool Corp. Gross margins are actually expanding, up 70 basis points in the quarter. Now this isn't luck, this is a testament to their operational excellence. It shows they have a dominant market position, which gives them two absolutely critical advantages. Number one, pricing power to pass on costs, and number two, supply chain mastery to manage their own expenses. They can literally squeeze out more profit from every single sale even when that top line isn't growing. This is the hallmark of a true market leader, and it's a huge reason why the bulls are so confident in this stock.
And look, if you still have any doubts about this bull case, just do one thing. Follow the money. Management is putting their money exactly where their mouth is, returning a massive $500 million to shareholders. They are buying back stock hand over fist, and they are hiking the dividend. Let me be clear. These are not the actions of a company that's scared of the future. This is a bold, loud statement of confidence. They are signaling to the entire market that their cash flows are rock solid and they believe their own stock is undervalued. So that's the bull case in a nutshell. A fortress-like maintenance business, expanding margins, and a management team that is all in on shareholder returns. Whoa, hold on a minute. A fortress? A secret weapon? I mean, that's a great story, but let's not get carried away here. Every fortress has a weak spot. And I am seeing some pretty serious cracks in this one. It's time to put away the pom-poms and start asking the really tough questions. Because all that talk about a solid foundation, well, it doesn't mean a whole lot if the entire thing is about to come crumbling down under its own weight. Let's take a good hard look at the other side of this story.
Okay, this is the chart. This is the one that should be keeping Pool Corp investors up at night. Sales are going down 1%, while operating expenses are going up 6%. This is the classic alligator jaw of death for any business. You simply cannot survive when your costs are growing that much faster than your revenue. This is what we call negative operating leverage. It means every dollar of sales is becoming less and less profitable. And all that feel-good talk about expanding gross margins, it's completely meaningless when your operating expenses are totally out of control and just vaporizing those gains before they ever hit the bottom line. This is not a minor issue. This is a 5-alarm fire.
And here's the proof. A 14% drop in operating income. Just let that sink in for a second. This isn't some complex accounting trick. It's not a one-time adjustment. This is the cold hard cash that the business is generating from its core operations, and it is disappearing at an alarming rate. That expense bloat we just talked about, this is what it looks like in the real world. A tangible, painful hit to profitability. This is the crack in the foundation that the bulls do not want to talk about, and you know what? It is getting wider every single quarter. Now let's talk about the balance sheet, because this is where things get really scary. We're talking about a mountain of inventory, nearly $1.5 billion worth. That's up 13% in a year when sales were flat. Now management, they call these strategic purchases to get ahead of price increases. Me? I call it a massive, reckless gamble. They have loaded their warehouses to the absolute rafters, betting the farm that demand is going to come roaring back. But if they're wrong, if this consumer weakness persists, this inventory is going to become a massive anchor, leading to write-downs, margin compression, and it's going to drag the whole company down with it. And where'd they get the money to buy all that inventory? Oh yeah, they borrowed it. Total debt has ballooned to over $1 billion. So let's just put this all together, shall we? Sales are down, core profits are down, and they're taking on more debt to buy more stuff that they might not even be able to sell. This is a classic, textbook recipe for disaster. They are not solving their operational problems, they are just kicking the can down the road with financial engineering and hoping, praying for a miracle from the consumer. That is not a strategy, it's a prayer. Okay, the skeptic has landed some pretty solid punches there, no doubt about it. The combination of falling profits and rising debt is a really serious concern. That alligator jaw is real, and the balance sheet is undeniably heavier. So the big question now is, what's the plan? What's next? Let's take a look at what management themselves are forecasting for the year ahead. Are they actually taking these issues seriously, or are they just crossing their fingers and hoping for the best? Let's see what their guidance tells us. So what is the official word from the C-suite? Well, they're guiding for low single-digit sales growth. In other words, they are not expecting any miracles. They are explicitly telling us that the new pool construction market is dead in the water and it's going to stay at these depressed levels. Any growth they do manage to get is expected to come from price hikes, which is basically just keeping pace with inflation. So the bottom line? The earnings per share guidance is effectively flat. Management is pretty much telling investors to just buckle up for a year of treading water.
Optimistic is one word for it? I think I'd call it delusional. I mean, let's be honest with ourselves. Where is this growth actually going to come from? They're admitting that new construction is a ghost town, so they're pinning all of their hopes on renovations and maintenance. But in this economy, right now, with consumers pinching every single penny and cutting back on big-ticket items, who is rushing out to remodel their pool? This low single-digit target, it feels less like a forecast and more like a wish. This isn't a forecast, it's a prayer. And I'm not so sure anyone is listening.
And here's the kicker. Buried deep in the fine print of the earnings call is a little detail that should make your blood run cold. Management notes that if they actually manage to hit their own modest growth target, it will trigger a $10 to $15 million increase in incentive bonus payouts for the executives. So even if they win, you lose. A significant chunk of any operating profit growth gets clawed back immediately. It is a built-in headwind that basically guarantees that any upside is going to be eaten up by higher costs. It is a classic case of heads they win, tails you lose.
All right, we have heard both sides of the story. The bulls have made their case for a resilient cash cow business. And the bears, well, they've pointed out some very real and very scary cracks in that foundation. We've even heard what management themselves have to say, including that fine print. So now it is time to put it all on the scales, to balance the risk against the reward, and to deliver the final iron financial verdict.
So here's where we stand. The bulls, they're betting on the company's moat, that massive recurring revenue stream from the maintenance business. They see a well-run, best-in-class operator with real pricing power that can weather any storm. The bears, on the other hand, they're looking at that hurricane that's already hit the new construction market, and they're saying, this is just the beginning. They see a company with runaway costs, one that's drowning in debt and inventory, and they are not at all convinced that the maintenance business is enough to save them from their own bad balance sheet decisions.
So what is the bottom line here? What's the verdict? Pool Corporation is a good company in a very, very tough spot. That maintenance business is a legitimate cash machine. It's a true fortress in the world of discretionary spending, and it provides a stable foundation. But right now, that fortress is under siege. It is being attacked from the outside by a brutal cyclical downturn, and it's being weakened from the inside by those rising costs and a seriously bloated balance sheet. The bull case is real, but so are the red flags. The strength is undeniable, but so are the threats.
So you see, this isn't a simple buy or sell. It's really a bet on time. And the question you have to ask yourself is this: how long can this company tread water before it starts to drown? Because if this downturn drags on for another year, maybe two, and that alligator jaw of rising costs keeps closing, all that debt and all that inventory is going to start looking a lot less strategic and a lot more like a death sentence. The answer to that question, and that question alone, will determine whether this is a once-in-a-lifetime buying opportunity or just a classic value trap. The choice is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.